Good afternoon. It's a pleasure to be with you. I want to begin by congratulating Peter on what I think is an outstanding book. I think his theme is very important. Statists have done an unbelievable job of creating a myth, a myth that Peter described, which is the financial crisis was caused by deregulation of the banking industry and greed on Wall Street. Now, one of the ironies, the banking industry was not deregulated. We had a massive increase of regulation under George Bush, the Privacy Act, the Patriot Act, Sarbanes-Oxley, and then the whole idea that there was a plague of greed on Wall Street I find strange. In my 40-year career, there's always been plenty of greed on Wall Street, but there's not one shred of evidence there was any more greed than usual. So that's just something made up out of whole cloth. That's where it came from. I have to acknowledge a real debt to Peter and to Alex and to Ed. I also wrote a book called The Financial Crisis and the Free Market Cure, and I used a lot of research in particular that Peter had done in my book, and I owe him a big debt for that because he is the one person that's really seriously put together the numbers that some of us that were in the industry intuitively saw that was happening. So his work has been very valuable to me. I very much agree with the arguments presented in these individual papers. And actually reading Peter's book was pretty easy for me because I'd already read his papers. I read them when I was running BB&T, and they helped me make good decisions. We kind of intuitively knew something was brewing, but it was very helpful to have facts to encourage us not to do the kind of things that got a lot of other financial institutions in trouble. My company did do much better than any large financial institution in the United States for a variety of reasons, but one reason was the arguments that Peter was presenting that were influencing and reinforcing what we intuitively knew was happening. Some of his themes, I think, are particularly important. The role of the housing policy going back really a long time, but particularly in the early 1990s, and its impact on the economy, the cause of the bubble, the role of Freddie Mac and Fannie Mae, along with the Community Reinvestment Act. He also, in the book, deals with some things that I think are non-trivial, that are a little academic, but are important. Things like the very destructive nature of fair value accounting, the myths created about the so-called shadow banking system, and there was nothing shadowy about it. The myths created about the role of derivatives, the myths created about credit default swaps. He looks at all of those things and destroys one by one those myths as causes of the financial crisis. He also talks about the role of regulators and the destructive nature of the regulation. It wasn't that regulators were just neutral in this crisis. They were huge incentives for destructive activity. They were very negative causes of the crisis. So in all of these themes, I think Peter's work is very important. I think it is more convincing if you think about the fact he was writing this while this was happening. And I think that, and he was actually, in many cases, you can see him projecting where we were going. In every case he projected forward turns out to be true, which I think makes a much more powerful argument. I think one thing you are supposed to do when you do this kind of feedback is to say, well, where would you disagree with Peter? And I don't know that we disagree, but I know these things were not focused on in his book. In my book, and my own belief is that the real fundamental cause of the financial crisis were errors made by the Federal Reserve. We don't have a private banking system in the United States. We don't have a private monetary system in the United States. We have a government-owned monetary system. If you have problems in the monetary system, they are by definition caused by government policy because the government owns a monetary system. And the Federal Reserve has been very destructive and very creative of economic cycles. In this case, Alan Greenspan made some really bad mistakes in the early 2000s because he wanted to go out a hero. We were having a minor economic correction. He created negative real interest rates, which is a huge incentive for people to borrow, and particularly an incentive when house prices were appreciating. And then Bernanke created an inverted yield curve, which for the banking business is a disaster because banks borrow short and lend long. We suddenly had negative spreads, which was a whopping incentive for people to take excessive risk, which is one reason this bubble went exponential the last several years. So the context in which these mistakes were made were really Federal Reserve policy, and they got reflected primarily in the housing market because of government housing policy, and specifically Freddie Mac and Fannie Mae. And overinvestment in housing is particularly destructive. That's why this was an unusually big bubble. It was pushed further, but it was also very destructive because housing is consumption. People don't think of housing as consumption, but you consume a house. So we incented a massive overconsumption, which is analogous in agriculture to eating our seed corn, which is one reason we've had such a hard time getting the production process going again. And while this process went exponential, we taught millions of people how to build houses, how to be real estate brokers, how to be mortgage bankers, and they've been having to learn new jobs. So this housing misinvestment in the context of Federal Reserve monetary policy was particularly destructive from an economic perspective, and something we've been trying to recover from. The other thing, I don't know that we disagree on this, but Peter doesn't talk about this, and that is, I guess I'm for a more radical solution. I do not believe that you can, as long as the Federal Reserve and FDIC insurance exists, I think it is naive to believe that the risk isn't created by the system itself. It's not big banks that create risk in the financial system. It's the Federal Reserve. And what they're doing today is incredibly risky to our economy, off the chart. And I don't care how good a bank you run, if the Federal Reserve is leveraging itself and its leverage has gone off the chart, then the system is riskier. So the system is riskier today than it was when this crisis started. It may or may not burst in that regard, but individual institutions can't manage risk within the context of a bigger systematic risk. So I'm for going to a private banking system using a market-based standard like a gold standard. If we aren't doing that, my own recommendation is that at least a step we could take was to require banks to have much more capital than they do today, as they had when we had a private banking system, which is something like 20% pure equity, and then repeal 95% of the regulations, including 100% of Dodd-Frank, and let the market take care of the allocation of capital. And I think that's a better solution than what we're working on today. I would share Peter's enthusiasm, and maybe more personally, about repealing Dodd-Frank. It's hard. I'm still on the board of BB&T. It's hard for an average person to realize, but the banking system in the United States has been nationalized. It is very much controlled by the government today. And if you want to control an economy, control the allocation of capital. And particularly if you can do it if you don't get blamed when things blow up, which is exactly what happened with subprime lending, right? So they can dictate that banks allocate capital in a rational fashion and then blame the banks when it doesn't work. It's actually far more powerful than socialism. It's a much more statist solution. And the reason the left jumped on this issue is, boy, it gave them justification to do something that they never could get justified, which is nationalize the banking system. And the reason they have so much intensity, and I share with this Peter, they are really scared about any attack on this myth. They really depend on this myth. I've had interviews with numerous reporters, some of which claim to be economists, and anytime you bring up this alternative solution, it's not that they just argue with you. They get emotional intensity, because if you undermine this myth, everything that's happened since this crisis started doesn't make any sense. It's a real threat, and they want it to make sense because they really want statist control of the system. So Peter is right. This is a big, important issue about the future of our country, because controlling capital controls an economy. So again, I would congratulate Peter on a job extremely well done. Thank you.
Thank you, John.